Based on the latest market analysis from leading financial institutions, the stock market's response to the conflict with Iran has been swift and significant. We are seeing a broad sell-off, a dramatic surge in energy prices, and a clear divide forming between winning and losing sectors. At the heart of this volatility is one critical concern: potential for prolonged disruption to oil supplies through the Strait of Hormuz. Let's break down what's happening across the markets. Starting with global indices, the selling pressure has been intense. The Dow Jones dropped over 2%, its first in nearly a year. S&P 500 futures slid by 1.8%. Overseas, losses were steeper. Europe's STOXX 600 fell 3%, Japan's Nikkei 225 down 3.1%, and South Korea's KOSPI plunged over 7%. The epicenter of this market shock is energy. Brent crude briefly topped $83 a barrel, its highest since mid-2024. It's not just oil. European natural gas futures doubled. Asian LNG prices jumped 45% after attacks on Qatari facilities. This energy spike reignited inflation fears. Goldman Sachs states a 10% oil price increase could boost the consumer price index by 28 basis points. Market expectations for Federal Reserve interest rate cuts are tempered, with June rate cut probability dropping significantly. Looking at winners and losers, a distinct picture emerges. On the winning side, energy companies, particularly North American exploration and production firms, refiners, and LNG companies, are poised to capture supply gaps and benefit from these higher prices. Defense stocks are also moving higher, with prime contractors expected to see increased demand. Cybersecurity firms focused on protecting critical infrastructure are becoming go-to plays in this elevated threat environment. And as always during times of uncertainty, we are seeing safe havens strengthen. The US dollar is gaining ground as the preferred currency, while gold is holding its value as a traditional store of wealth. On the losing side, the picture is quite different. Airlines and cruise lines are taking a direct hit because they're so sensitive to fuel costs, and unhedged operators are particularly vulnerable. Regional route suspensions are adding even more pressure. Consumer discretionary stocks and global brands are under pressure as rising inflation expectations and a hit to consumer confidence weigh on the outlook. The semiconductor sector is also struggling, with the Philadelphia Semiconductor Index falling over 2%. Amid supply chain concerns, this is why chipmaker-heavy markets like South Korea and Taiwan have seen some of the steepest declines. Looking at emerging markets more broadly, nations that are net oil importers, such as India, Thailand, and South Korea, are particularly vulnerable to the dual shock of higher energy costs and a stronger dollar. In contrast, oil exporters like Malaysia and some Latin American countries are proving more resilient. So with all this happening, the big question on every investor's mind is whether to buy the dip or brace for more pain. Opinions are divided, though everyone agrees we're in a period of heightened uncertainty. On the cautious side, BCA Research advises that it's too soon to sell the rip in oil or buy the dip in stocks, recommending a continued risk-off approach. Barclays echoes this, warning that the risk-reward for buying equities isn't compelling yet, especially if the conflict proves prolonged. Morgan Stanley suggests investors remain defensive with a quality bias during this volatile period, but there is also an opportunistic view. Goldman Sachs strategists advise seeing any correction as a buying opportunity, citing economic resilience and robust earnings. They point out that most geopolitical shocks in recent years haven't had a long-lasting impact on markets. In fact, some investors are already deploying cash to buy beaten-down emerging market ETFs. Looking at historical context, Morgan Stanley notes that following past geopolitical shocks, From the Korean War to Russia's invasion of Ukraine, the S&P 500 has delivered average gains of 2%, 6%, and 8% over 1, 6, and 12-month periods respectively. However, UBS warns that today's high equity valuations, with the S&P 500 trading at more than 22 times forward earnings, make markets more vulnerable than during previous shocks. In summary, the stock market is actively repricing risk based on the new reality of the Iran conflict. The core variables to watch remain the duration of any Strait of Hormuz disruption and the consequent path of oil prices. Those two factors will dictate the ripple effects through inflation, interest rates, and global economic growth moving forward.